Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 7th of September 2019 and we're providing our gold and silver weekly update for the weekend in the 6th of September. We also highlight the sudden movements in both gold and silver prices this past week and the reasons for those changes. Gold fell $13 last week from $1,520 to $1,507, having hit a high of $1,557 and a low of $1,502. In sterling terms, gold finished the week at £1,227, that's down £23. And in euros it closed at €1,365, that's down €17. Silver fell 19 cents, from $18.37 to $18.18, having hit a high of $19.65 and a low of $17.98. In sterling terms, it closed at £14.81, that's down 30 pence. And in euros, it closed at 16.48 euros, that's down 0.24 euros. The gold to silver ratio rose marginally from 82.74 to 1 to 82.89 to 1. The Dow Jones closed on Friday at 26,797, up 69 points on the day and up 394 points on the week. And the Nasdaq closed at 8,103, down 13 points on the day, but up 141 points on the week. And the S&P 500 closed at 2,978, up 2 points on the day and up 52 points on the week. So a good week for equities. The dollar index stands at 98.39, that's down 0.52 on the week. We ended last week's update with the following words, when gold stood at $1,520 and silver at $18.37. Quote, "The direction for next week will be determined whether traders push gold above $15.27, which could see it rise as high as $15.65, or if it falls below $15.25, then we could see a pullback as far as $14.70. For silver, we would not necessarily be buyers at this level, even though our last two videos have predicted higher prices before the end of 2019. But we do feel that buying has been a little overextended and are expecting some pullbacks, certainly towards the $18 level, and more than likely back towards $17.50, though there may be another 20 to 30 cents in the price before this happens." Unquote. So, looking at gold first, it rose from the beginning of the week, peaking on Wednesday at $15.57, and then dramatically falling on Thursday and Friday morning, attempting a rally, and then fell back again towards the closing, ending down $13. So our analysis or forecast was basically a little too bullish on the upside for the week and a little too bearish on the downside. But the trend certainly was correct. And this is against the backdrop of every pumper's disciple, and virtually every gold and silver YouTube channel stating, "This is the start of the launch to the moon we are going." Our inbox was literally inundated with newsletters, email warnings, video podcasts from pumpers, and yes, we subscribe to most of them to see what they're churning out, telling us that this train is unstoppable and that the only way is up. Well, if you bought at Thursday's peak in gold, you're already down $50 an ounce, and in silver almost $1.50 an ounce. Now, does this matter long term? No, it doesn't, as we are still bullish both gold and silver. But can you see how one can so easily get caught out? And that's just in one day. Anyway, so let's briefly analyze what actually happened last week. On the weekend, the new tariffs levied against China came into effect, even though China was hoping that a stay would occur so that negotiations could take place. This did not happen, and on Sunday, the 1st of September, 15% tariffs applied to more than $125 billion worth of Chinese imports. And China, in return, imposed additional tariffs of between 5 to 10% of some of its $75 billion list worth of US goods, with a balance, because it didn't apply to all the $75 billion, with a balance to take effect from the 15th of December. Now, Wall Street was closed for Labor Day on Monday, but we could see from other exchanges and markets that they did not like this move, and on Tuesday we saw a sharp increase in the gold price. On Wednesday and Thursday morning, this is British Standard Time, we saw additional positive momentum as Treasury yields lowered and the US dollar weakened. However, Thursday afternoon BST, gold prices began to fall quite significantly and continued into Friday morning on the back of some positive trade and economic news, which includes China and the US agreed to go back to the negotiating table in October. US yields moved higher following a report from ADP that showed private payrolls grew larger than expected. Jobless claims were in line with expectations. Moves within the British Parliament made it less likely for a hard Brexit to occur. Suggestions were circulating that the European Central Bank policymakers believed that it's not yet time for the ECB to start buying bonds again. That is, it would delay its QE program. And also we suspect it's not unreasonable that an element of profit-taking was also carried out, bearing in mind that technically gold was overbought in any case, without additional highs being achieved earlier in that week. Then, a few hours after we put out our video on Friday entitled "Why Did Silver Prices Fall Yesterday?" and we put a link below, where we highlighted a number of the above factors as they also relate to silver, the non-farm payrolls were announced, which were very disappointing, showing only 130,000 new jobs gained for August, against market expectations of anywhere between 150 and 170,000. And we saw gold rise some $22 in less than an hour. Now, some of our subscribers were quick to call us out on this, as our video stated that we expected gold and silver prices to fall. But they completely missed the paragraph we put in towards the end of that video, which stated, quote, "Now, if the payrolls are stronger than 170,000 by a good margin, we can expect to see gold and silver prices fall further. If they are weaker by a good margin, they are likely to rise. And if they are as expected, we still see a slight deterioration in prices, but markets will remain cautious until the Fed's interest rate announcement due on the 18th of September, unquote. So we suggest that we were actually quite accurate with our assessment. For even though the job figures surprised almost everyone, that despite the $22 rise in gold, it still fell back 20 of those dollars, which does not bode well for next week's opening. Now, despite the excitement of last week, gold actually fell 1%, roughly, which is now its second weekly loss. This suggests that markets have fully factored in any rate cut expected from the Fed on the 18th, and are looking to see how the economic data continues to pan out, together, of course, with any geopolitical activity, which could affect it in either direction. From a technical point of view, there now appears to be resistance near the 10-day moving average of 1531 and support near the 50-day moving average of 1465. And both short-term and medium-term momentum has turned negative. Now, silver more or less moved in unison with gold, except the prices rose much more significantly on a percentage basis, and then declined appropriately. Again, the same factors have affected silver as they did gold, except that in our view silver was more overbought than gold, and therefore in percentage terms, short term, we did expect a little bit more of a pullback than we actually achieved. From a technical analysis point of view, a large shooting star was formed, which suggests that a pullback in prices is the most likely outcome. Now, some analysts believe that a pullback to around 1750 could indeed prove positive, with the bulls then beginning to buy again and potentially push silver up to $20 and perhaps beyond. Now, this coming week we have a fair amount of economic data being announced before next week's FOMC interest rate announcement. So let's take a look at what's ahead. On Monday, we have the consumer credit figures for July. Tuesday, real median household income for 2018. Wednesday, producer price index for August and wholesale inventories for July. Thursday, consumer price index for August and core CPI for August. And on Friday, retail sales for August, import prices for August, and the consumer sentiment index for September. So all in all, quite a lot of data to take into account, and which the FOMC will also consider when making its interest rate decision on the 18th. So, next week, we are expecting some further pullbacks, with gold falling below $1,500 and silver below $18. Not dramatically so, but a fall nevertheless. That said, we are also aware that the Iranian situation is heating up, in that it announced today, for example, that it has begun using new advanced centrifuges to enrich uranium, the latest step in reducing its commitments under a 2015 nuclear deal with world powers. Now, Iran stopped abiding by two commitments in July in response to sanctions the US reinstated when it abandoned the deal. President Trump wants to force Iran to negotiate a new agreement that will place indefinite curbs on its nuclear program and also halt its development of ballistic missiles. But Iran has so far refused. So this needs careful watching from a geopolitical perspective, as it can prove quite volatile. On the plus side, however, Jerome Powell, speaking yesterday, stated that the US Federal Reserve will act, quote, as appropriate to sustain an economic expansion in the world's largest economy that has been pressured by uncertainty over global trade, thereby giving a hint of lower rates ahead. Though we tend to envisage frequent small 25 basis point reductions as opposed to 50 basis point reductions at a time. However, we shall speak more on this in another video. Meanwhile, we hope you have a most pleasant weekend and prosperous week ahead. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.